Right, question 76. So what we have here is a new project that is considering the use of a machine that's currently sitting, and it has a current book value of 12 grand. You can probably imagine this is totally irrelevant, and a potential disposal value of 10,500 before disposal costs. So really the net book value, the net realizable value if we sell this thing is really 10,500 minus 200. So this is the opportunity cost. We can sell it for this, or we can carry on with the project. So it says it's under depreciated. It's not fully depreciated by 1,500. That's fine. So the question is, what are the relevant costs when it comes to taking on this project? And I think this is also a very good example in terms of comparing relevant costs with relevant income, so to speak. So if we want to fit this machine for purpose, if we get it to work, we will have to pay another 500 and refit it. 500 refit it at an additional cost of 800, and that together is another 1,000. Oops, sorry. I think, oh yes, sorry. So I have 10,300 plus an additional 1,300, and that takes me to 11,600. Now, what's really this question of relevance is really saying that whatever I'm going to do out there with this machine had better bring back something greater than 11,600. That's the whole point about relevant costing. It's saying that look at all the options you had not to do this. So I could sell this machine for 10,300. I'm going to have to pay some extra costs of that. So whatever I have coming better be better than this total figure here. So that's what relevant costing is really about. So that's question 76. Right, let's look at 77. So here we're interested in the relevant sort of fixed costs. I mean, there's some fixed costs here that we need to deal with as we carry on with this new project. So let's look. So existing fixed overheads are absorbed at a rate of £8 an hour. So I'm not interested in anything that's existed in the past, if you like, because I'm now trying to make decisions about the future. I want to know that whatever the relevant costs are, they are well matched by any relevant revenue. So it says the project will involve, what I'm interested in is the extra machine running costs, and it says these variables will cost him £4 an hour. So these are variable overheads that I know about. So 4 times, it says the number of machine hours expected to be 450. So I want to be as accurate as I can. That's the plan. So he's expecting 500 labor hours, but the difference of 50 is because he thinks he needs some idle time. No, I just want to put in what is relevant, what I know of. I can't be putting in any guesstimates. This is very clear. This is £4 and 450 hours. So we have here 4 times 450, which comes to 1,800. And it's very clear that it says you will need some for a while, which will be 1,200. Add the two together, and you have 3,000. Okay, great stuff. So your answer here is A. Right, let us look at all the relevant costs here. There's quite a few we have to get to choose from. So clever clogs are shorter labor. So they have a couple of options. What they can go out there is that they can say, listen, we need 600 hours of labor. So we're going to go out there and we're going to get that labor from an agency. And that agency, you would have to pay them £9 an hour. So you have one option of putting on your statement potential cost here 5,400, or you could recruit new temporary staff by getting you have some fixed advertising of 1,200 and then paying 600 times 6, which is 3,600, and you now have a cost of 4,800. So that's your other option, option 2. So let's call this option 1. And let's call this option 2. And then your third option is that, listen, we're going to deviate some of the work from another department where we pay £7 an hour. So 600 times 7, 4,200. Any additional issues? Yes. You will lose also a contribution of 3 as well. So you will have a total cost to think about. That whatever is coming in has to be better than this, because you are also giving up a contribution. So basically there's a cost of 1,800 that you are, a benefit, so to speak, benefit of 1,800 that you are giving up, and that comes to 6,000. So in terms of what's the relevant cost, what costs are you going to go with, or what costs are you going to record, this is really the option that you're going to go with, 4,800, because that's the smallest. If you like, that's what's the relevant cash flow is, of course, the one that's the sort of the cheapest cost option, so to speak. From a prudent point of view, this is what you should really be doing. So the relevant cash flow, the important cash flow in terms of comparing it, you see, because if you're going to compare this with, say, for example, income was going to be 5 grand, then that's the relevant cash flow, your cost you're going to go with, because you can do this for 4,800. So the answer here is D. Okay, so with 79, what we have here is a picture of our friend Drippy. Interesting name. Drippy is going to producing a list of relevant cash flows, and she's considering a new type of stick that guarantees better protection. So, well, she's considering this project, is considering launching a new project. But currently, what she has right now in place is she manages existing products and has a standing arrangement with a tech company. The contract has been signed and covers the next 12 months. So payment is made in the month following an advert appearing. She's going to use the mag to advertise her exciting new USB. So in terms of the best description for the cost here, really it's not a past cost that it's done with, and we don't really use the term historic cost in relevant costing. This is more a financial thing. It's not a relevant cost. So in effect, really, it's a committed cost. So some costs apply to kind of past costs. For example, there was an example we did where this guy had spent £75 on traveling to see a client regarding a deal, a negotiation. That 75 is sunk. It's in the past. It's done. Here we are still looking into the future, but we are committed to paying it. So the answer is D. Right, and so the last two questions in this series here says, which of the following terms can be used to describe a relevant cost for a decision? And we've used the expression incremental. Oh, sorry, which of the following would not, right? So incremental is, future is, it's a cash flow. We don't use the term material, not really in this sort of area. Yeah, so the answer is material is not normally used. Again, this just sums up what we've been talking about all day. You need 250 rims. You currently have you currently have 100 in inventory. You will need to buy 150. So if you're going to buy 150 rims, that's 150 times 26. You have to go out and buy that. So 150 times 26 is 3,900. Oops, sorry, 3,900. But you have 100 rims in-house that are not being used, and we're not modifying them. So it's just really the opportunity cost. What's that selling price? So 100 times 10 is 1,000. So add on 1,000 to the 3,900, and you have 4,900. So the opportunity cost plus the opportunity cost of 100 rims, if you like, and the cost of buying in some new rims as well. Great stuff, and that brings us to the end of that question list for relevant costing.